Thank you, Rutuja. Good morning to all. On behalf of Monarch Networth Capital, we welcome you all for the Tata Metaliks second quarter FY 2021 earnings call. We are glad to host the management at the call today. We have their MD, Mr. Sandeep Kumar sir, and CFO, Mr. Subra Sen Gupta sir. So without taking much time, I'll hand over the call to Mr. Sandeep sir for the opening remarks. Thank you, and over to you, sir.
Yeah, thanks, Sahil, and good morning and welcome to all. Well, the quarter two results for us has been very positive, and I think this has been a great factor for us, will be a great factor for us going forward as well. The key reasons for the rebound, as I mentioned earlier in my television interview also, are following. Number one, it's the improved spread between the pig iron and the raw material prices. We saw a surge in the pig iron prices, which I mentioned in the last call also in July. The pig iron prices had reached almost 34,000 rupees, and the raw material prices remained stable. So that is one of the major reasons. The second reason, of course, is the increase in sales volume of pig iron, and I'm comparing this year on year because there is no point in comparing with quarter one. The third point, which is often a neglected one, is the cost efficiencies. We've had a significant improvement in our cost efficiencies compared to quarter two of FY20, and this has been led by primarily by the PCI and the oxygen project, which we have been talking to you for the last couple of years. So they have started bearing fruit. I had also mentioned about that we had run a performance improvement program for almost about 7-8 months with the help of an international consultant. Now, all this has led to stability in our upstream performance, and we believe now that on hot metal side, we have now become the lowest cost producer. We always thought we are the lowest cost producer in the ductile iron pipe side. Now we also have achieved that number as per our internal benchmarking and the assessments that we have done, that we have one of the best fuel rates in the industry, in the secondary pig iron industry. And we already have one of the, I think, the lowest conversion costs in the pipe business. So cost-wise, I think we have done extremely well. That's what is controllable by us. The other factor which is not controllable fully is the market, but that's been positive. So both these factors have helped us. So that's in summary the story. In terms of numbers, I'm sure you already have the numbers, but just to kind of recap, we've had a profit before tax of 90 crores compared to, let's say, about 23 crores year on year. And if you look at the revenues have been at 520 crores compared to, say, 511 crores. So revenues have remained more or less the same, but the profitability has increased significantly. The EBITDA margins have gone up to, let's say, 21% compared to, say, about 8-9%. Typically, the EBITDA margin for the business remains at about 15 to 16%. That's an average EBITDA, let's say about 15. This quarter has been unusually good, so that's why it's touched 21. And of course, quarter two of FY20 was unusually bad, so it was, let's say, about 8-9%. So I think that in a way summarizes our performance for quarter two. And I think there would be questions, and if you look at the way forward, how is quarter three looking and quarter four, I will talk about it as we go forward. With this, I will close my opening commentary and wait for the questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Srimant Tudoria from Unifi Capital. Please go ahead.
Good morning, gentlemen, and congratulations on a great set of numbers. The first question is on the pig iron spread. Of late, we have seen the coking coal prices rise again sharply, and there is some correction also. So are the spreads remaining the same for us, or is there any change as compared to the quarter two?
So good morning, and thank you for your opening question. The spreads will obviously come down because of the fact that the raw material prices have started going up. In fact, if you look at iron ore, the iron ore prices have almost doubled, almost 80% increase we have seen between, let's say, July and October. If you look at the coking coal prices, it was hovering at about $110 or so, the prime hard coking coal FOB. That moved up to, let's say, 140, is now down to 120. So the coking coal prices have, let's say, if you compare with July, let's say, has moved up by about $10, $12. So it's not that significant, but iron ore has almost doubled. So that will certainly impact the spreads. The coke prices have moved up from, let's say, 19,000, 20,000 rupees to, let's say, about 24,000, 25,000 rupees. So all in all, there is a cost push on the raw material side. As far as the pig iron prices are concerned, they were at a range of between 33 and 34, and they are range bound and they are moving in that. So therefore, there will be an impact on the spread in quarter three. That is my expectation, but obviously nobody can say so with certainty.
Sure, sir. Thanks. The second question on the DI pipe volume ramp up. How is the demand now picking up at the sites? Is quarter three the same? The quarter three and quarter four looking the same as it usually been in the second half?
So the DI pipe business is greatly impacted by the investments by the government. That investments is something which we will have to wait and see to what extent it continues, because obviously the government is spending a lot more money on, let's say, health and COVID related, affairs. And the revenues to the government have been much lower than normal. So we have been expecting that there may be a slowdown in government investment. But what we have found is that as far as our payments are concerned, they have been coming in time from almost all the governments. So we haven't seen any delays in payments, which would normally get actually reflected if the government was under stress. So that's one positive. The second positive which we're expecting is that the government stimulus on demand side should come. Now, whether it comes over the next 3 months or over the next 6 months, I don't know. But even we had a session with Sanjeev Sanyal recently, and he also said that he's expecting a demand stimulus to be put by the government. The government is waiting for an appropriate time. I think if the demand stimulus comes, then I think we will be, there would be an obvious kind of effect on the projects being speeded up, because there are enough projects in the pipeline. UP is coming up has actually come up and has actually allocated tenders also with almost about 6 to 7 lakh tons of DI pipes. Andhra Pradesh is another one with, let's say, 4 lakh tons. So between these two states itself, you will find that almost 1.2 million is getting covered. Then we have Odisha, then we have West Bengal, Jharkhand, Madhya Pradesh, Gujarat. So we have a number of states. So as far as visibility of projects is concerned, there is, the announcements are there. Now we have to wait and see how many of these get converted into executable ones. So that is the point with which we will have to wait and see.
Sure, sir. So the UP and the Andhra orders, which you said together 1.2 million tons, has that already been awarded to the EPC contractors?
Yeah, many of them. The UP ones are much ahead. And in fact, the UP EPC contractors have in turn started offering the projects, the supply contracts to the DIP manufacturers. So that's also started happening. Andhra Pradesh is another one where the projects have begun because of the change in government that got delayed. Otherwise, that should have started much earlier. But now that's got stabilized and the tenders are being allocated, are being announced, and the allocation has started happening. So I don't think that will be a problem. The issue that will come up is whether the government has the money to actually execute the projects at a speed at which it was envisaged. It will certainly go ahead. The projects will go ahead, but the government must have money. So that is my concern. So that is something which we'll have to wait and see. And if the central government announces some stimulus on the demand side, then we will see water infrastructure getting a certain percentage of it particularly because water and sanitation are also linked to health, and therefore they should be getting some money.
Sure, sir. So on 21st September, we took shutdown for one of our furnace. What is the likely impact of that shutdown in quarter 2, if there was any, and what will be in quarter 3?
So let's say we lost about 10 days of production. Okay, so 20th, 21st, whatever. Let's say we produce on an average 50,000 tons per month. Okay, so we would have lost, let's say, 15,000 tons. Just a rough number. So that is the kind of impact. Out of 15,000 tons, let's say we would have made 10,000 tons of pig iron and 5,000 tons of ductile iron pipe. I'm just giving some rough number. So that's the kind of tonnage which we would have lost in September. Similar or maybe slightly more we will lose in October, because the furnace is still under repair. It is planned for more than a month. We are likely to, restart the furnace soon, and we will notify you in the stock exchange as well shortly. So that's been done almost complete now. So that's the kind of loss we have had in September, and that's the kind of loss we will have in October as well. Maybe a little bit more in October.
Sure. So finally, on the new capacity commissioning, on the timelines, are things now falling in place in terms of the plant and machinery imports?
See, the new project, we have been doing some work on the basics of civil and structural. There have been issues in terms of finding labor, particularly because the project labor comes from outside. There's a skilled labor also. So there have been various issues on the project side, which has actually delayed the project. So last time I had mentioned to you about that the project has been delayed by anywhere between 6 to 9 months. And, it looks to me that this delay will continue for a bit more time, because those issues are still there with festivities and the COVID infections. We are also going a bit slow. We don't want to take a risk of having too many people inside the plant, because every single person who comes inside the plant, we test them, we quarantine them, and before we let them enter. Then you can imagine about 4,000, 5,000 people entering the plant every day. It's not an easy job. Of course, the new ones, the project guys, for example, for our blast furnace shutdown, we have 500 people inside the plant. Now, these 500 people have come from outside, most of them. So we had to test every single one of them. Right. So there are issues related to that, which is leading to some amount of delay. And of course, there is no issue in terms of cash and in terms of money or our commitment to complete the project. It is just that we are being a little conservative, and we don't want the plant to get impacted, because what happens is that we have had huge number of, almost about 2,000 people we have tested. Almost about 200 people have been found positive. For this, every person that you test positive, there are 3, 4, 5 who are through contact tracing are put on home quarantine. So the entire operations gets affected. And that's a point I forgot to mention, that, this performance in quarter 2 is despite COVID. And COVID has had a tremendous strain, because we have not been able to fully run our operations in the way that we would normally do. Despite that, the cost efficiencies have been there. And of course, there has been the help from the market as well. So keeping all of this in mind, I would say that the project is right now on a go slow, and we will get more clarity over the next 2-3 months as we go forward in terms of pushing it. So we're not pushing it hard. It's just going slow because of these factors.
Sir, thank you for the updates. I'll get back in the queue, sir.
Yeah. Thanks.
Thank you. The next question is from the line of Akshay Satija from Alpha Invesco. Please go ahead.
Hi, sir. Congratulations on good set of numbers, and thank you for the opportunity. Sir, as you mentioned, the pig iron prices right now have gone upwards of 34,000, and the raw material prices have also started increase. So do we see a similar trend in pig iron going forward? Will we see a rise in prices, and are these prices really sustainable?
Yeah, thanks. So the pig iron prices, you can assume, is between 33 to 34. Okay? Mm-hmm. And you can say the coke prices are, let's say, about 24 to 25,000. So the coke prices were at a level of, let's say, about 20,000. 20, 21, whatever. Now, they have moved up by 3,000 to 4,000, while the pig iron prices have been range bound between 33 and 34. So they have remained now more or less same over the last, I would say, 2 months in September. Okay. And although there has been a hike in steel prices from 1st of October, that also helps to some extent the pig iron, our pig iron prices also, although it's not directly related, but there is some correlation. So to that extent, these prices are being supported. And I think the level of 34,000, if I were to say what is the price in Punjab today of pig iron, they have reached 37,000. But that's artificial price because of the farmers' agitation. What's the price in Delhi? It's more like 34.
Okay.
So I would say that the prices are more range bound between 33 and 34. They go up and down, so they're not falling majorly or they're not going up majorly. While the raw material prices, which moved up, the coal prices and the coke prices have now over the last 10-15 days, let's say, come down somewhat. So let's say about 1,000 rupees. So to that extent, there is some amount of volatility, but both are range bound right now.
Okay. So would you say it's better to track the Delhi benchmark prices instead of Ludhiana, at least for the quantum of Tata Metaliks, from the quantum of Tata Metaliks?
Yeah, for everybody right now, because of the farmers' agitation in Punjab, rake movement of cargo is not happening. Like, for example, we send it by rakes. So it's not reaching Punjab because of the agitation. Okay. I'm hoping that agitation will be called off and then things will become normal. So right now, Punjab prices will be artificially high because of the shortage. Delhi is better to track. Delhi or Gujarat.
Sir, I also wanted to understand slightly the industry scenario currently on pig iron. Are we seeing any new capex coming in, and is it really viable to build a new pig iron capacity, and what sort of capex is required for building pig iron capacity?
So typically, if we were to build let's say a ductile iron pipe plant of let's say 2 lakh tons backed up by a blast furnace, of let's say 2.5 or 3 lakh tons, then we say a capex of about 1,000 crore. Okay. The back end will take, let's say, 500, 600 crores, and the front and the downstream will take, let's say, about 400 crores. Just broadly speaking, 400 to 500 crores. So that's the way it is. A broad thumb rule you can use is about 1,000 crores for an integrated ductile iron pipe plant on a greenfield basis.
Okay. And what would it be in terms of brownfield? And could you give a little landscape on the industry we are seeing right now? Because we've been continuously seeing decreasing production in pig iron for last 4-5 years in our country. So where is this industry actually moving forward?
So the castings industry, so pig iron is of two kinds. One is the steel grade, which goes into making steel. The other is the foundry grade, which goes into making castings. And the castings in turn go for various applications, including railways, engineering, auto, all that. So we are in that business. We are not in the steel one. So the chemistry is different. The product is different. Although to some extent at the margins, they substitute each other. But that's only at the margins to some extent. So for the castings industry, if you look at it, it has been growing at a level of about 5 to 6% every year. But castings are of various kinds. There are steel castings, there are ductile iron pipe castings, there is the normal grey iron castings where we supply. And that is dependent upon auto and engineering and agriculture and all that stuff. Sanitary castings like in Howrah, manhole covers, etc. So this is moving at in a range of about 5 to 6%. It is not for an industry which is growing at 5 to 6%, it is not something which is great in terms of the long-term future, and that is the reason why we are moving, out into the ductile iron pipe. So while we'll continue to have the pig iron as a balancing business and as a small part to, in some sense, hedge, but virtually 70% to 75% of our business would become ductile iron pipe in, let's say, over the next 2 years or 3 years. So that's the movement direction of our business. And pig iron business per se is not a greatly attractive business. Either you make steel out of it, and you know the steel cycle, or you make castings out of it, like Kirloskar and ferrous, and get into the further downstream.
Okay. Are we looking to get into casting side, or are we focused on DI pipes itself? Do we have any plans in that direction?
So we have examined, as a part of our long-term strategy, about a couple of years back, we had done a detailed strategy alignment and with the help of an international consultant. And we've kind of zeroed in on what we want to do. Our strategy right now is to focus on the water infrastructure sector, and therefore the ductile iron pipe is I think, very key part of that. So right now we are focused on expanding in the ductile iron pipe business.
Okay. So final question. So what, as you just mentioned, that we are the lowest cost producers now in pig iron. We already were in some DI pipes. What would be the approximate cost per ton in terms of raw materials for pig iron?
So the raw material price, would vary, because of the raw material prices fluctuate so much. So there will be no meaning from that perspective, to ask what will be the raw material cost. Okay. So generally, just to give you a sense, of the hot metal cost, the coke costs constitute about 60%. Okay. So of the direct cost, I'm talking about not the fixed cost, 60% cost is coming from coke. So that will give you a sense of, so it's primarily led by the raw materials.
Okay. Got it, sir. Thank you so much, sir. Thank you for the question.
Right. Thanks.
All the best. Yeah.
Thank you. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Good morning, sir.
Good morning.
Sir, I just want to understand that our DI pipe sales has been down almost 30% in the first half. So how much in the second half we think we should be able to recover, or what kind of the guidance we have in terms of volume this year?
Okay. So the way to look at it is that the ductile iron pipe business typically is about is skewed towards the second half. Okay, the first half typically is slow. Two reasons. Number one, Q2 has got monsoons. So in monsoons you don't have enough. The project sites get flooded. Okay, and there's not enough work that happens. And Q1 is because the government money gets spent in March. Thereafter, to get the new year funds takes a bit of time, and then the summer heat. So because of this, about, let's say, 55 to 60% of the business happens in the second half. That's a general trend. Now, Q1 for most of us was a washout because of COVID, because of the lockdown. Q2, both monsoons and COVID have impacted our sales. Right, and that's why you see that Q2 we have had a dip compared to Q2 of last financial year in ductile iron pipe. The pig iron moved up, but ductile iron pipe, because even though we had firm orders and everything, but we could not move material because some sites got blocked because of workers getting COVID, or somewhere else the offices got closed and the inspectors could not come. We were also very particular because in ductile iron pipe, the inspections have to be done. We were not encouraging people to come into our plant. Okay, if you had to come, then you had to be tested. All these problems have been there. So all that has impacted. So otherwise, generally about of the annual volumes, you can assume 60% definitely will be in H2.
Understood. So sir, what kind of guidance in terms of absolute volume we are giving right now, if any?
So we are not giving any guidance. We normally don't give. But I still give you in some sort of an indication as to what is, the kind of volumes that we do in the second half. And I think second half is going to be better, much better than first half, for obvious reasons that I just explained.
Understood.
Do you understand what I said? Or you want some?
Understood. So basically, net the second half should be better, and it should be 40-60 kind of the ratio. It should be in terms of volume.
Correct.
Is that a right understanding?
Yeah, that's right.
Yeah. Okay, my second question pertains to our net cash. Sorry?
Yeah, I said at least 60% of the total year should certainly be there in H2, if not more.
Understood, sir. So my second question pertains to our net cash status. So I believe we are already at 99 odd crores of net cash. So considering that we are going slow on the capex thing and second half is expected to better, shall we safely assume that we would remain, despite capex, we would remain a net cash company going forward?
So you can see very clearly that we are already positive cash. Okay. And the capital expenditure is right now has been kept under control for obvious reasons that I explained a little while back. Because of COVID, because of labor not being there. So the capital expenditure is not happening to the extent that it would have happened normally. So we should, continue to do well on the cash side as we go forward. And it will also depend upon, how quickly we expedite the capital expenditure. So we just want to wait for and a little bit more time, see that these infections have to be under control because, you can't have too many labor coming in at the same place and working and infecting everybody else. So that is a major concern for us. And that is one of the reasons, as I said, is we're going a bit slow.
Understood. So, sir, what kind of capex we are pending for the second half, if you can give us the figure?
So we are taking a call on the capex, quarter on quarter. But let's say, whatever we have spent in the first half, we would certainly spend a similar capex. So, Shubhro, you want to just answer that? Shubhro?
Yeah. So, because in the first half we have spent around 66 crores. So we'll spend a similar number, 60-65 crore in the H2. And definitely will continue to be on the cash positive side.
Understood. And sir, if I may squeeze in one last question. So in terms of competitive intensity, since the DI pipe has been a little bit weaker on the first half side, so how we have seen the competitive intensity, and is it impacted in terms of, the bidding of the new orders? There any price pressures on the new orders as of now we have seen?
Yeah, so you're right. So there have been, because of the market situation and because of the COVID situation, the prices have come down. We have seen a drop in prices in ductile iron pipe, and so the new bookings are happening at somewhat lower levels. But with the upsurge in the raw material prices, I think the producers will have to think twice before dropping prices any further. In fact, the way the raw material prices have moved up, I would think that people should be looking at hiking up prices now. But because what happens is there is normally a lag between the raw material prices and the ductile iron pipe prices, there would be some impact of the fall and the negative situation on the ductile iron pipe, which we are seeing now. But now again, since July, as I said, after let's say from September, October, prices went up, so that impact should play out sooner than later. It depends on how long this rally sustains. If the raw material prices continue to rally, then that will start impacting your DI pipe prices also, because then the producers will know that, look, we can't keep dropping prices anymore because now the rally is up and their costs will go up. So that's a natural reaction. Typically 3 to 6 months, there's a gap between the raw material and the DI pipe prices, seeing that. So we'll have to weather out the next couple of months to see how things move.
Okay. So any indicative pricing which you can share with us, like 1,000 or 2,000 drop we have seen as of now, or any indicative numbers if you can give us?
So it is being, we are seeing, different kinds of price drops in different areas. And, but certainly you can say between 5 and 10% drop in prices are being seen. There could be a little bit more also, but 5 to 10% drop is being seen, here and there. So you can say, let's say about $1,000 and $1,500, this kind of. So that will be maybe more than 10%, not 5%. So let's say about 10%, 10, 12%, or 15%, even up to that. In some cases, you are seeing a drop.
Understood, sir. Thank you for that's all from my side. Thank you for taking my question.
Sorry. Let me just clarify. As a percentage, it would be lower. So let's say if your market prices are let's say about 50,000, so then if you are seeing a drop of let's say 10%, then you would see a drop of almost about 5,000 rupees. So you are seeing anything between 3,000 to 5,000 rupees drop. That gives you.
Understood, sir.
Yeah. Okay.
Yeah. Thank you, sir, and all the best for future.
Yeah. Okay. Thanks.
Thank you. Ladies and gentlemen, to ask a question, you may press star and one now. The next question is from the line of Rajesh Majumdar from B&K Securities. Please go ahead.
Yeah, hi. Good morning and thanks for taking my call, sir. So, sir, I had a very basic question on this entire iron ore, semi-finished and steel rally. So we have seen that the basic premise of this rally has been a shortage of material both globally as well as locally. So while it is difficult to comment about the global situation in iron ore and where it's heading, we have seen a case where in India, most of the merchant miners have bid for rights at such a astronomical price that they have become unviable to lift output from most of the 12 mines that were auctioned earlier on the year. So given this scenario, the entire rally has been, to my mind, fueled more of a shortage of ore rather than anything else because the demand was not there really in the first 6 months. Now we see that the demand is coming back. What's going to happen? I mean, there is no likely conclusion of the ore mining that we can see immediately. So is it going to be that prices will go through the roof and all the end products, or how is it going to play out? I wanted your opinion on this.
So let me give you some numbers that will flesh out a few things in your mind. If in Odisha, roughly about 150 million tons of iron ore is produced. Okay.
Right.
Out of that, let's say 80 million tons was captive and 70 million tons was merchant. Now 40 million more has moved to captive. Okay, so the captive guys will become, let's say, 120 or 110 rather, and about 40 million. So just a little bit of an. So let's say the merchant now is close to about 110 million, so 40 million, and 110 is captive. Okay, but this 40 million ton movement, should have happened from October, and that has also led to the rally because there was an uncertainty about the guys picking up the mine. So transition phase, permissions, all that. However, we have to note that these guys who have taken over the mines are going to pay astronomical royalties. They are paying as much as the market price. So obviously the cost for them will go up significantly. Okay, how they are going to make money, I don't know. That's another mystery to me. But even say they make money in some ways, the fact of the matter is that the cost of iron ore available in the marketplace for all those guys who have bid is going to be much higher. What it means is that people who have captive mines from before, like Tata Steel and SAIL, will become more competitive than these guys. This is my sense. Now, the other impact that you would see is, for the merchant guys, if the number of mines is reduced, and if there are not enough players, and if the number of players remains the same, then the price should logically go up, isn't it? Because if it was 50-50 earlier between merchant and captive, and now captive has taken over almost, let's say, 110 million tons, and only 40 million is left for merchant, that means only 40 million tons is available in the market. But some of these guys who were earlier buying through merchant have now become captive. Right. So there is a little bit of a game here which we need to see as to what extent of trading happens of iron ore in Odisha, which is a major player. Okay, and that will determine your prices of iron ore going forward. As of now, this is in a bit of a flux, and that is what is leading to a rally. I hope I made.
So that's what I wanted your opinion on that, because now, see, earlier the demand was not much and still prices were rally. Now that demand is starting to come back, we will be in a situation where there will be an acute shortage of ore from the merchant mine. So do you think prices can really go through the roof in terms of a super cycle in steel? Or
so anticipating that, the prices have doubled. That's why I said iron ore prices have doubled, 80% to 100% depending on fines or lumpy. They've already doubled in October. Between July and October, that's what my opening comment was, that the iron ore prices have almost doubled. But if you look at coking coal went up from $110, let's say, in July to $140 in early October, and back to now $120. That's because there is a problem between China and Australia.
That's right. Yeah, that
So
was
there
the
are
next
various.
question.
So if you look at the cost-wise, the coke is the major factor, coke cost, which is 60% of the cost, and the input is coking coal. There the prices haven't moved that much. So they have moved, but then they have dropped again. So we will have to see, and the futures is also not looking that high. So coking coal prices as of now don't seem to be, sustaining a rally. Iron ore, because of this fluid situation in Odisha, is leading to a rally. Now I would believe that this would get stabilized to some extent in Odisha as we go forward, and the prices should cool down. But still there would be a gap, and I think iron ore prices will remain at a higher level than what they were in the past. Now, whether they will have a super rally and all, I don't know, because that all depends on how many guys start operating the mines. Because if you go into details of these mines, if my price is 2,000 rupees and if I'm going to pay the government a royalty of another 2,000, it doesn't make sense to me. Why will I buy iron ore at 4,000? I'd rather buy iron ore from the market at 2,000 than produce iron ore, at let's say $1,000 and pay royalty of $2,000. So that's the difficulty and the complexity which we will have to figure out why these guys are bought at such high rate. So just to summarize, in general, the cost push for iron ore is going to remain. To what extent will depend upon how the situation stabilizes over the next few months. While on coal, things are much better. But there again, between China and Australia, how things pan out will determine the international coking coal prices.
Thank you so much.
Yeah, right.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Good morning, sir.
Good morning, Saket.
Good morning, sir. And Pujo Shubhechha and Niven, sir. To you and Shubhroda. And sir, firstly, sir, I missed your point about the lower realization in DI pipes, sir. What led to that, sir? Why have the prices moved lower, sir?
So you look at the situation saying that with COVID coming in and everybody anticipating that the orders would be reduced, government doesn't have money, projects would get slowed down, correct? So if you look at it in the first 3 months, there was hardly any movement. Order bookings were very low. New projects which had been conceived also did not really concretize. It's only in Q2 now that we are seeing a movement. But that also movement is relatively slower. Okay, and there is still that concern that whether the government will have enough money to pump into these projects. That is the concern which would have driven some of the players to bid at lower prices and get the orders, because they don't know what the future is. Let me extract the order. Okay. So even though people would have been having orders, like we have almost about 7 months of order load, we would ideally like to have at least 9 months, but that is what a typical 9 to 10 months. But right now we are at a slightly lower order load. But we believe that with UP and Andhra and some of the others coming up, things should improve. But whether the prices will improve, because prices have started coming down already over the last 2-3 months, I don't know. Ideally, if the raw material rally sustains, the prices should again go back. Yeah, okay. Saket, does that answer your question?
The line of Mr. Saket Kapoor got disconnected. The next question is from the line of Srimant Zoria from Unifi Capital. Please go ahead.
So thanks for the opportunity again. Sir, this is regarding the indication which you gave. 60% of our DI volume should happen in the second half of this year. Now, given that the first half was largely impacted by the lockdown, is it right to assume that this 60% of what happened in the volume that has happened in the first half should happen in the second half for DI pipes, or it should be more to catch up for the lost sales in the first half?
No, what I said was that typically the volumes are about 55 to 60% in the second half. Okay, that's the typical way any year operates in ductile iron pipe.
Yeah.
Now, in this year, Q1 was a washout.
Yeah.
And if you look at Q2, we have done okay, not great. It's been in fact lower than, so we did about 49,000 compared to say 56,000 in the first half, in quarter one.
Yes, sir.
Now, if we were to look at a total volume, then of the total volume in a year, we would certainly do at least 60%, not 55, 60, but more than 60% in H2.
Yes, sir.
I would tend to think we should do more, much more than that, but at least 60% we certainly should do.
Sure, sir. So secondly, on the cost savings and cost efficiency that we have been working on, is it right to assume that the PCI and the oxygen plant have what we wanted to get from that has already now in the numbers?
Yeah. So we have started getting those numbers from PCI, from coke rates. So we've had a significant benefit coming in from both these projects plus other operational projects, which is already factored in quarter two. There would be some more improvements. We are doing some automation and digitization projects. So some more improvements in fuel rates also will be visible. For example, we are doing level 2 automation in blast furnace. And you will not find any other mini blast furnace having this in the country. That will give us some more benefits. So there are some other projects which are on, but the more significant part of the benefit is already coming.
Sure, sir. So what is going to be the financial impact of these further initiatives that you're talking about, and what are the timelines for those?
So I don't think we need to really specify. Let's do it and we will tell you, because these are not as significant like in the PCI. I had told you 30-35 crores. Oxygen, I had told you 10-15 crores. So virtually about almost 50 crores per annum of benefits is something which we had anticipated and which we had planned for. Okay. Now we are already getting, much more than that on a quarterly basis. So we are very comfortable of. In fact, that's the controllable part, and that's what we are very happy about and proud about. That it's not only the market, but our own cost structure is helping us. Now, additional benefits. There are things which we are doing, especially on digital transformation, which nobody else is doing to the level that we have done till now and what we are doing. For example, I had mentioned earlier that we are putting in robots. So we have now almost 4 robots in a plant already in the pipe plant. And with the new plant coming in, let's say in 2 years' time or something, we have a plan of putting in at least 30, 40, more robots. This is something which you will not find anywhere in the DIP industry, at least in India. You may see something in Europe. And these are not off the shelf. This is not like auto. So there are some major work we are doing, and the benefits of that we are not calculating right now, because it's not only about cost, it's also about other factors. It's about efficiency, it's about industrial relations, it's about, safety. So all of that we are not calculating right now, but we certainly feel that that's going to radically transform. So we're moving into the factory of the future. That's what we are envisaging, and we are working on that vision. So I don't want to kind of pinpoint and saying, okay, 5 crore benefit here or 10 crore benefit here, but the benefits would be visible. It's not like 35, 40 crore kind of. So obviously these are smaller numbers, and each project will not have, you will not have any single project of that nature giving you 35 crores or 40 crores. They're more like in single digits.
Sure, sir. And the new capacity that is now, with the further delay, should we expect now by the quarter 3 or by quarter 4 next financial year, sir? Is that now the revised timeline we should look at?
No. So I don't think you should assume that. We have to first, start it. Once we start the project with full gusto, you can assume another 12 months from then. So supposing if we start it on, let's say, in January. Right now we are going slow, as I said, because there are too many people coming in and too much of risk.
Yeah.
And we don't want to, spoil our current plant by building the future plant.
Mm-hmm.
Okay. So because all these people for projects have to be got from outside. Getting them all in, testing all of them, housing them, there is too many risks. So we have gone slow. Okay. And availability of people also is an issue, labor, the right kind of labor, etc. So what we are doing is we are conserving cash. So we also want to get more confidence, more visibility that, so that now with Tata Steel having funded 168 crores, we ourselves having a, free cash flow, so we being cash positive. So we are accumulating cash, building up the ammunition And moment we find that, the COVID thing starts coming under control, because right now in Bengal, you would appreciate with the Durga Puja festivities, etc., there is a huge amount of concern on the cases. Just going a bit slow. But as soon as we start, I think full go when we go ahead, it should take us about 11-12 months after that for the first phase of the project. And maybe another 9-10 months after that for the second phase.
Sure, sir. So earlier we were planning to start the power plant and the coke oven.
Sir, Mr. Sriman Dudoria, may we request you to return to the question queue for follow-up question, as there are several participants waiting for their turn.
Sure, I'll get back in the queue. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to 3 per participant. Should you have a follow-up question, we would request you to rejoin the queue. The next question is from the line of Akshay Satisha from Alpha Invesco. Please go ahead.
Hi. Thank you so much for the opportunity again. Sir, I had 2 more questions regarding to the PCI plant. So could you help us slightly understanding the economies of the PCI plant that we've put in? How is it really benefiting us?
How is it benefiting us? Oh, okay. So the PCI basically is pulverized coal injection. It is essentially replacement of coke with coal. The difference 1:1. So if we were to inject, or if we were to put in, let's say, 1 ton of coke, we can replace that one ton of coke with 1 ton of coal, and this coal is non-coking and therefore cheaper. So if the cost differential between coke and coal is, let's say, anywhere between 10 to 12,000 rupees per ton, so that's the kind of savings you will get. Shubhro also looks after the procurement of raw materials. I'll request him to respond to you in more details. Shubhro, are you there?
Yeah. So we have already covered. So we have done last 7 years data, and we found that average difference is around 10,000. So for 1 kg coal, the impact will be 10 rupees kind of thing. And if we operating cost, if we reduce that, then it will come to say 7 to 8 kind of number. So what MD was suggesting that 35 to 40 crore from the PCI is mainly on the say 80 kg to 90 kg coal injection per ton of hot metal, which gives around 35 to 40 crore benefit.
Okay, got it. Sir, as you mentioned, we are pig iron. I just wanted to understand our power consumption per ton of pig iron and DI pipe capacity. How much units do we? What's the number there?
Shubhro?
Say today the total power consumption is approximate 20 megawatt, plus minus 1. And our own generation is around 17.5 to 18. So on average, we buy from the grid is 2.5 megawatt. And you are aware that we are putting up a 15 megawatt power plant. And with that increase in the DIP volume and the other functionalities, still will be our total capacity will go to approximate 30 megawatt. And the total utilization will also be around 32 megawatt.
Okay. What would be your, if I look at per ton basis, what sort of efficiency are we looking at? What units do we consume per ton of pig iron manufacturing and DI pipes manufacturing?
Can you repeat the question?
So I was asking what units do we consume?
In case of DIP, the average consumption is 180 to 200 kilowatt hour per ton.
Okay.
That is more power guzzler. The otherwise, PI, whatever we produce from the blast furnace gas, the power we utilize in the PI. Say for all put together would be around say 100 kWh kind of.
Okay. So one final question. Could you give us a rough quantum of how many employees are required, say when we do 5 lakh ton capacity, so 2.5 lakh for pig iron and 2 lakh for DI pipes? What would be the employees required for pig iron and for DI pipes? An average, just a blended number.
So today we have got around 1250 employees, 1250 to 1300. For DIP, we will require additional 400 to 500. This I am talking about the permanent roles, people on the permanent roles. So all put together, we'll be having 1700 kind of numbers. And over and above, we'll be having around 2000, 2500, so 2500 of the contract laborers.
Okay.
Yeah, so let me just come in. So around we have currently on a regular basis about 2,500 of contract labor. Okay.
Okay.
And let's say about 1,200 of our own employees. That makes it 37. Let's say close to 4,000, because we have shutdown labor, project labor, all that. So you can say more or less 4,000 people. In fact, if you take your project in full scope, it will go up to 5,000. Okay. So that's the number. And as we double our DIP capacity, you can say that we will add anywhere between, let's say, 600 to 1,000, depending on the automation and the robotics that we use.
Okay. Okay. And how much employees would be working on the pig iron facility amongst these? Ma'am, it's just a follow-up question on the similar question. So how much of them would be in the pig iron facility and how much would be in the DI facility from the current 4,000 employees?
So let's say you can assume about say 60-40. 60% would be in pig iron and 40% would be 60% would be in the ductile iron pipe.
Okay.
55 to 60% would be in the ductile iron pipe and balance would be in pig. Pig iron actually has got other things also, power plant, coke plant, all of that I'm including. So it depends on the upstream side. There are a number of things. Raw material handling, all that is being included. General staff, all that we have covered there. So
got it.
Directly, if you look at it, about 55 to 60% would be coming in from ductile iron pipe. Say 55%.
Okay. Got it. Thank you so much. Thank you so much for your question.
Yeah.
Thank you. The next question is from the line of Anurag Patil from Roha Asset Managers. Please go ahead.
Thank you for the opportunity, sir. Can you help me with the volume numbers for Q2 and Q1 in terms of DI pipes and pig iron?
Shubhro, can you answer? Shubhro?
Sorry, I was in mute. So you are asking about the volume number.
Yes, sir.
In H1, we have done 76,000. Out of that, 49 in Q2 and 27 in Q1. And pig iron, we have done 180,000. Out of that, 86 in Q2 and 32 in Q1.
Okay, sir. Thank you very much.
Thank you.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yes, sir. Thank you for the opportunity again, sir. Got disconnected. Sir, over the period, this 15-20 days, there were two major M&A, if you can say, both in the DI pipe as well as in the pig iron by your competitors. So in DI pipe, two of the largest players are getting amalgamated. And in pig iron, Kirloskar bought VSL Steel. That will up their capacity by 1.5 lakh ton in the pig iron space. So, sir, how are we reading these two development and the availability of pig iron going forward, sir? Because I think so they have given a timeline of 6 months for which it will get commercialized.
So as far as the ductile iron pipe is concerned, there is no change in capacity. It's simply 2 plus 2 is 4. Same group.
Yes, sir. Yes.
They have just added.
Yes,
right?
Okay.
So they may have some benefits, energy benefits, etc., which I am not aware of. But possibly when they are merging, there must be something in mind. As far as the pig iron is concerned, Kirloskar acquiring the VSL facility, we are aware of that. We have also examined it in the past, but we did not see it fitting into our overall business, and therefore we did not go ahead. For Kirloskar being in the south and running its castings business, it may be having its own plans. I don't think it makes any sense to anyone to get into pig iron business on its own because of the fluctuations in the volatility. Typically, if you look at the margins, the EBITDA margins of pig iron business and our pig iron business, which is far more, I would say, profitable than the steel pig iron business, because we make the foundry grade, we serve a very large number of customers. I don't know all those details whether you have, because we sell to small customers, small foundries, and therefore it's more of a distribution. And the moment you sell to small customers, your profitability is higher, your margins are higher, your premiums are higher. But then you have to have a marketing network, you need to have distribution, all that. So, per se, the pig iron business is not greatly attractive. However, in, let's say, conjunction with the ductile iron pipe business, the pig iron business can be a balancing business. It can act as a hedge. It can tackle some amount of cyclicity. And therefore, to us, it is more of a balancing business as we go forward. Today, it is about 48% of our revenues. As we go forward, it will become, say, about 25 to 30% of our business. We may increase this 70% to, let's say, 80% or 85% as we go further forward. So we have some strategic plans in place, and we will take a call as we go ahead, depending on the environment and depending on the appetite that we have.
Sir, the raw material price increase, which you have spoken especially about the iron ore as well as for the coke one, how has been the trajectory for the last quarter? When the prices have started from the very beginning or towards the end of the quarter?
So the iron ore movement happened, iron ore, let's say the lump prices, they moved up between July and August partly, and then they have moved in October, while the fines have moved in September. The fines, the prices have almost doubled in September. And this is I'm talking about in Odisha, and the auction prices that normally I'm just giving you an indication of that. So you can say that part of the prices have moved up in quarter 2 and partly in quarter 3 in October.
So the major impact on the iron ore will be visible. The compression in the margin will be in the third quarter itself only.
That's what I said initially only, that the raw material prices increasing, your spreads will be under pressure.
Right.
Yeah, so but part of it was already absorbed in quarter 2 also. It's not that fully, because July to August we saw, increase in prices in lumps. And coking coal we saw increase in September.
Right. So for DI pipe deliverables, you told 60% of last year, that is around 2,17,000 we did for last financial year. So we should expect something in the vicinity of 1.2 lakh for the H2. That should be a good indication.
No. I didn't say that. What I said was that typically 55 to 60% of the volumes is done in H2. But this year the H1 being lower, therefore, as a percentage, this will be more like 60 plus. So instead of being 55, 60, it will be at least 60%. It should be 60% plus. 60% this year there is also the issue of money and the COVID also. No? So if that continues, to what extent it will impact, I don't know. COVID has not gone away. Correct? So the reason why the volumes have not moved, have not been great in H1 is because of COVID primarily. Because as I said, project sites could not get operated. Government offices were closed whenever there was a COVID, outbreak.
Right.
So all of that can continue in quarter 3, can continue in quarter 4 till we get a vaccine or till we get out of that. So and that's why I'm saying we can't say with certainty. There's a lot of uncertainty because of COVID, and therefore we don't know. That's the reason I'm saying. But in general, we are hopeful that at least 60% of the volumes this year will come in H2.
Thank you very much. The next question is from the line of Chintan Sheth from Samiksha Capital. Please go ahead.
Thanks for the opportunity, sir.
Sorry to interrupt, Mr. Sheth, but there is a disturbance from your line.
Is it okay now? Is it audible now?
There is a static disturbance from your line.
Yes, there is some disturbance. So possibly you can log out and log in again. Call back again.
Okay, sir. Sure, sure.
Meanwhile, the call can be taken by someone else.
Yeah, sure. Okay.
Thank you.
Yeah, it's now okay.
Yes, it is. The next question is from the line of Raj Gandhi from SBI Mutual Fund. Please go ahead.
Hi, sir. Thanks a lot for the opportunity. If I recollect that you mentioned, the project execution will take, phase 1 will take 12 months from the beginning of full-fledged work, and phase 2 will take another 10 months after that. So is that correct understanding?
Yeah. Hi, Raj. Good afternoon.
Hi.
So, good to hear from you. Yeah, that's right. That's right. So, we have done part of the project. We've also ordered equipment. The civil and structural work has been going on. Of course, due to COVID and due to monsoons, that was slowed down, and that will continue. So we don't want. So some work will continue, but on a slower scale. But we don't want to order the equipment, bring it in and then not know what to do with it. So when although we have contracted with suppliers and all that is done. So a lot of things have already happened. The engineering work, the detail engineering, the basic engineering, the procurement part, tying up, all that has been done, designing. But it's a question of now execution and erection. So you're right. It will take about 12 months for the first phase and let's say another 10, 11 months for the second phase.
Okay. And sir, just, given how India-China situation is and a lot of our equipments are coming from China, so, is there a case of just getting the equipment right now, if possible, because tomorrow if there is any issue in getting the equipment, and also some experts and all required. So, how will that equation play out, and any way to de-risk that by, getting at least the equipment and all of that?
Yeah, so that's a difficult question for me to handle. I don't know what will happen. But if you ask me, I think this India-China, are quite intricately involved economically. The supply chains are very closely involved. So other than the posturing that is happening, my belief is that this will not worsen. Even if something happens, it will be more temporary because today you can't work like this. Mm-hmm. So that is number one. Number two is that, the alternative to China in many of these cases are not great. Although we have been working and we have had some breakthroughs in some of the consumables and raw materials, especially over the last 1 year, because, this thing has developed over the last few months. But we have been conscious of this and we have been working to diversify our sourcing base over the last 1.5 years, and we've had some significant success, I would say. But I was still there in the trial stage, so I don't want to announce it right now, in the sense mention it in the call. But we've got, for example, we're procuring something from Israel. We've developed a vendor in India who's very well-known one. So now the trials are going on. I hope that some of these things, if they succeed, it will be good for the DIP industry. It will be good for us and also for the industry in general in India. But for the capital equipment, it is not that easy. We can't change suddenly because the technology, the engineering, the layout and all that is fixed. So we can't, it's not an off-the-cuff, consumable that can be done. So it's not easy to move out from the suppliers. And they are equally keen to supply.
Okay.
Yeah. Okay. Right. Thanks, Raj.
Thank you. The next question is from the line of Ashish Shah from Centrum Broking. Please go ahead. Mr. Shah, your line is unmuted. Please go ahead with your question.
Hello?
Yes, Mr.
Yeah.
Shah.
Hi, good afternoon, Sandeep sir. This is Ashish Shah from Business Match. How are you, sir?
Yeah, hi Ashish. Good afternoon. I'm fine. I hope you're good.
Good afternoon, sir. Good afternoon. So just two questions, sir. One was, at the start of the call, you mentioned that, you've now become the lowest cost producer both in PI and DI segment. Would you be able to share what is that cost efficiency difference between you and the next competitor?
I think we will not get into that. It's always very, very difficult to exactly know what one's cost structure, what the cost structure or what the cost elements are for competition. But we have done some assessments, and if you have heard me in the past, I have always maintained that in the DIP we are the one of the lowest cost. We are actually the lowest cost, but in the upstream side we are not as good. But on the upstream side, in hot metal, after the projects we have executed, the structural side and the operational side, we believe now we have reached a stage where we are one of the best, if not the best. And then we have done some benchmarking with some of the key players, and we share, sometimes we do this benchmarking and share data in terms basis that I am telling you. But since these are shared in confidence, it will not be proper for me to kind of give these numbers.
Sure. And sir, does this cost efficiency also open up any export opportunities for us now? I mean, going ahead.
Export opportunities.
Yeah, I mean, this is the fact that now is the lowest producer. Does it make us more competitive to address that side of the market, or not really?
No. So you see, it only means a higher margin.
Okay.
The price remains the same. If domestic is better, why should I export?
Okay.
So that's export is not a priority for us in pig iron.
Sure.
Okay. We do export, but these are small quantities to some select markets.
Sure. Okay, thank you very much, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Ms. Pankaj Bobade from Axis Securities. Please go ahead.
Thanks a lot for taking my question, and congratulations on very good set of numbers. Sir, my first question is regarding as you mentioned in your earlier commentary that our sales revenue mix will change from 50 to 48 for DPI to PI, and to 75% for DPI going forward. So, and ours is a branded product. So, and also that we are supplying it mainly to for government floated tenders. So, what is that? What is the visibility do we have? Is there any demand supply mismatch expected going forward in the demand supply for DPI? And what is the differential margins do we have over in DPI to PI, which will help us increase our blended margins, and what that would be?
Okay, I'll request Shubhro to respond to that. Shubhro?
Yeah. So the first point is that ductile iron pipe is more of a engineered product, because PI is more of a
So your voice is very low. Can you please a bit louder?
Yeah, is it better?
Yeah, it's better now.
So what I was saying that ductile iron pipe is more of an engineered product and much more value added compared to pig iron, which is more of a commodity. And the margin of ductile iron product, EBITDA margin, if you see the competition with the only the ductile iron pipe manufacturer, is approximately 20% average EBITDA, and we have got definitely similar or better than that. Whereas pig iron is much more cyclical, and this quarter it is much better number. So always the endeavor is to move from commodity to product, and from a steady margin from to fluctuating margin to steady margin. So our objective is long term to go to DIP around 80% of our total volume, and 20% will remain in pig iron, and that too in the local market where our pig iron margin is steady and much better.
Okay, and regarding the brand which we are having, and how does it make any difference in the government tenders?
So the government tenders are mainly is in DI pipe, and in DI pipe almost all the competition's products are branded. Our USP, the brand USP mainly in the pig iron, where we are the only branded pig iron in the market. And our brand promise is that our pig iron melts faster, as pig iron is an intermediate product and used to manufacture the casting. So our brand promise is that it requires less power and fuel to melt it. Whereas DIP, all the products are branded products. But definitely, as our quality is better than most of the competition, in a lot of cases, we get the first right of refusal from the private players.
But in government tenders, which mainly decides on L1 basis, how much difference would it make?
Yeah,
it will not make.
Let me just come in.
Yep.
Just let me
sure.
come in. See, in government tenders, you are right. It is L1, but our government business is only about between 10 and 15%. Balance is with the EPC contractor, most of it. Okay, a little bit is through the dealers also, but mostly it is with the EPC contractors like L&T, Voltas. There are many companies like that. Mega. Now there, what happens is that typically these EPC contractors are not only do they have to execute the project, they are having to maintain the project, the pipeline and the water flow, etc., for 5 to 10 years. In some cases, it's even more than 10 years also. But 5 to 10 years is a common thing. Now, our value proposition is that you will not have any hassles in having a product and maintaining it over the next 5 years or 10 years. And that is why we need a premium from you. And that is why we get some amount of premiums, which may be in the range of, let's say, anywhere between 1 and 3% over most of the competition in many cases. And in fact, I would say in most cases, which, let's say, 2 years back we may not be getting, but today, because of the brand promise that we have, and we believe that we are getting those premiums. So while Shubhru mentioned about the right of first refusal, yes, in some cases it is the right of first refusal. In many cases, it is a premium which we get. And we are, offering technical services, we are offering financial instruments. Those are differentiators which are helping us get those premiums, which currently is not very significant, as I mentioned, between 1 and 3%. But more importantly, we try and convince the customer that there is value in buying a product because of the product quality, the services that we offer, etc., etc.
And sir, final question: do you see any?
May we request you to?
This is my third question. Do you see any demand-supply mismatch going forward in DPI?
So DIP typically is working at an industry capacity utilization of almost 80%. There are plants like ours. I think Tata Metaliks is the only one which is working at, say, last year, if you look at it, almost 115-120% of the capacity. Okay. So other plants may be operating somebody at 70%, somebody at 90%, somebody at 100%. So generally the industry is healthy. There are only 7 or 8 players. Okay. And going forward, this has got entry barriers, so it's not easy for anybody to come in. The demand is increasing at a rate of, our earlier projection was at a rate of 9 to 10%. Of course, because of COVID, this will come down temporarily for a year or two. But otherwise, I think there is a steady demand. And in general, I don't see too much of a mismatch. Because like we are expanding capacity, I believe Sri Kalahasti is also expanding some capacity. So there may be some additions here and there, but you will not see a massive addition because it's not easy to get into this business. It's not easy to be competitive. And there are a huge amount of entry barriers both in production as well as in marketing.
Thank you, sir. Thanks a lot.
Right.
Thank you. The next question is from the line of Viraj Gupta from Kotak Securities. Please go ahead.
Yeah, hi sir. My question has been answered. Thank you.
Thank you. The next question is from the line of Chetan Phalke from Alpha Invesco. Please go ahead.
Yeah. Thank you, sir. Thank you for the opportunity and congratulations for a great set of numbers. So I have only one question. Can you just give some idea on the overall landscape of the foundry grade pig iron demand in India? I mean, what is the current demand and who are the top players and what is the installed supply, etc., especially for foundry grade?
Okay. Right, thanks. Thank you for your compliment. So On foundry grade pig iron, you can say typically, let's say if we are producing and selling more than 300,000 tons, and our market share is about 20%, 19 to 20%. Okay? And we are the second largest player in the industry. Cesar is the largest. Okay? So that will give you an idea of the overall market size for about foundry grade. And I'm not including the steel grade in this. So you have to be able to mark that. Okay. The players, the three main players are Cesar, Kirloskar, and Tata Metaliks. There are other smaller players, but they are like, they move between steel grade and foundry grade, and and in a blast furnace you can't keep doing that because fluctuations in blast furnace are not good. So therefore most of them stick to steel grade. So it is not that there are too many players who are consistently offering their material, but what happens is that the steel grade or the basic grade, which is one grade above that, or the low silicon grade, they can eat at the margins of the foundry grade. So foundry grade is basically silicon of more than 2%. Okay. Steel grade is, let's say, 0.7, 0.8%. Okay. So that's the difference. Now to move from 0.7, 0.8 to more than 2%, not many people can do that, or even in the sense because it's not worth it. Okay. We are focused on it, therefore we have automated our process and things like that. So because we don't produce steel grade. So that is the difference between, the steel grade and the foundry grade. And talking about foundry grade, that's why you have fewer players, and that is the reason why it's perhaps will be a little bit more stable than the steel grade. But still, because of the steel grade does impact, so it's not so insulated. And that's why you find some fluctuations which are quite large at times from the market side.
Okay. Yeah, and as you mentioned, no new capacities are coming, so we can expect further consolidation in this industry, or share of, let's say, top 3, top 4 players only going up going forward.
Right.
Okay, all right. That's it, sir. Thank you.
Right. Thank you.
Thank you. The next question is from the line of Srimant Dodia from Unified Capital. Please go ahead.
Yes, sir. So a couple of questions. Firstly, given the feasibility of large state government orders that you highlighted in the initial part of the call, UP and AP together itself makes about 1.2 million tons, and there are a few other states that are also increasing the demand. Would this give kind of a demand-supply mismatch in the industry? Because I think the capacity additions for the larger players like you and Kalahasti, I think somewhere down in FY22. And would this give a kind of better pricing power to DI pipe manufacturers? That's the first question.
So if you look at the DIP margins, the EBITDA margin in the DIP business for us is 20% plus. Okay. And we will see there could be some temporary dip this year because of as I said, the prices dropping. But in general, I think as the order books start flowing in, I think this will come back. And therefore, there is more optimism in the future. As far as the capacity versus demand is concerned, I think the demand is going to be steady. It may slow down a little bit in terms of executable orders over the next 6 months or a year or so. But otherwise, going forward, government is committed to spend on the water infrastructure, which is poor in this country. And therefore, over the next 5 to 10 years, I don't see any reason why the industry will not grow at a level which is close to 10% or more. It has, over the last 5 years, it has grown at a level of about 8 to 9%. And the next 5 years, this government in particular has been very aggressive. And therefore, we are not assuming 15% or that. We are saying, let's say, at least 10% growth, which is very reasonable. If you leave aside this COVID years, I think a growth of 10% is very much likely. But from a capacity side, we are not seeing the growth in the same way. Like our project is delayed. I don't see too many capacities coming up. So going forward, there seems to be more optimism, although in the interim, there may be some hiccups, like currently there are.
Sure, sir. Secondly, on bookkeeping questions, our tax rate for full year should be what, sir? What should we go by?
Shubhro, you want to answer that?
Yes. We are still in math, so our tax outgo will be 17.42% on the book profit. On the provision side, it will be around 20% plus minus on a yearly basis.
Sure, sir. And lastly, our power plant is on schedule, sir, which was coming up ahead of the other thing.
That's right. So it is likely to come up by end of this year. There could be at most a month of delay or something. So again, the same issue as I was saying of labor and availability and all is a problem. Testing, getting them in, a lot of precautions we are taking, so all that is taking a toll. But otherwise, it's more or less on track. We had said quarter 4, so it's more or less at the end of quarter 4, hopefully. Otherwise, April at first it should come.
Sure, sir. Thank you and all the best.
Right. Thanks.
Thank you. The next question is from the line of Dhiral Shah from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir. Congratulations for the good set of numbers. Sir, in your opening commentary, you talked about cost initiative which you have taken, and this has made you the cost efficient player in the market. So it will have a positive impact on your margins, right?
That's right.
So you have guided for 15-16% kind of EBITDA margin. So do you see further upside in that?
No. So see, the margin would be dependent both on the market and on the cost. So market prices, for example, in quarter 2 have been very good. The spreads have been very good. Now, what will be the spreads in quarter 3 and quarter 4? I don't know. And I can tell you something. Like today, they're looking good, but they're not as good as in quarter 2 because the raw material prices have moved up. But then again, coal fell down in the last 10 days. So it's a little unsure of how things will pan out. But in general, quarter 3 is looking reasonably good, though not as great as quarter 2. However, what will be made up is in terms of the sales volumes, which may be better, or at least somewhat better, even if not significantly better. And quarter 4, the volume should be still better. So the volume side should be better, especially in quarter 4. Margin side is difficult to say, though at the moment it's not as bad as normally it would be, but not as good as quarter 2.
Okay, so margin would remain at around 15-16%, right?
Yeah, so that's what I explained to you. It would depend. Like this quarter, the margin is 21. So if I assume 15-16%, which is the normal margin, it is, I think, quite reasonable to assume that. I think it's quite reasonable to assume a margin of 15-16%, but there are so many factors, so really to pin me down to a number may not be correct.